My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey folks, welcome back. Today, my special guest is an old friend I haven't seen for a number of years, Jay Balekar, who is zooming in from Cincinnati, Ohio. And Jay, when we first connected a number of years ago, you were just getting rolling with real estate. Now you are a going concern. Jay and his partners have done multiple deals. They're focusing on multifamily properties, and they're doing very, very well in this space. So Jay, welcome to the show. Great to have you.
Thank you for having me, Dave. It's a pleasure.
So Jay, give us a little snapshot of what your real estate business looks like as of, my goodness, almost the end of October 2025 as we're recording this. What does the portfolio look like these days?
Yes, so since we started, late 2019 is when I started. I have two more partners. One of my partners has been doing this a little longer than I have. We have a little over 18 deals now, a few exits along the way as well. We have sold some of our smaller stuff, and we are trying to scale up to mid-sized and larger multifamily. 50 to 150 units is really our target.
Yeah.
But multifamily continues to be our main asset class. We've decided to focus on one asset class because as you know, things changed in the last few years, and multifamily was no longer the favorite child for a lot of people. People started looking into self-storage, office, other commercial assets. But we decided we just wanted to focus on multifamily because we had taken a lot of time and effort to get good at what we do. So there was no point in changing our focus. And we truly believe in multifamily as an asset class for long-term wealth generation.
So what market areas do you typically buy in, Jay?
We have been very focused in the areas that we live in. So that's Cincinnati metro area. But now we are also looking at deals in and around Cincinnati metro area. So that includes Columbus, Ohio, Indianapolis, and Lexington, Kentucky. Okay. So everything that's in 1.5 hour driving distance from Cincinnati, because we do have our own property management company here. So if the property is close enough, then we can be on site and we can have a full-time team on site and manage it from central location, which is Cincinnati.
So how many units do you have in the portfolio at the moment, Jay?
So currently close to 600. We have one more acquisition that we are working on. Hopefully we'll close on that one by the end of November. So we'll be at 650. Knock on wood, I hope we close that deal. It's a sweet deal. Nice. But we'll be at about 650. So I think that's a kind of a sweet spot. Now we have to make more investments in our property management company, construction company, and our operations. But we are looking forward to that growth and having full-time teams on our assets.
So what you kind of talked about the size of the asset that you're looking for. Are you guys focused on value add still, or do you like to buy them up and running and working nicely already? What are you guys looking for?
In the past, we've done only value add, and at many times we actually did deep value add down to the stud renovations. Mm-hmm. In nicer neighborhoods where the juice was indeed worth the squeeze, and we were doubling the equity within a year sometimes. Lately, we are focusing more on cosmetic value add or even turnkey properties if purchased at a good cap rate and if they're cash flowing day one. Reason being because the cost of capital has gone up, and renovation costs have, after they went up, they didn't really come back down as much. Yeah. And the rent growth has slowed down. So the ROI on the renovations has dropped quite a bit. So which is why, again, the juice is not worth the squeeze. So we are not really looking for those deep value add deals anymore. And if we are able to get that cash flow without exposing our investors to that construction risk, then that's even better. But even now, if we find a deal that's in a class A or B neighborhood that does require a lot of work that we can buy at a very good cost basis, and if we can get at least 30% return on our construction dollars spent, then we'll still do it. It's just getting harder to find those deals.
Yeah. So when you guys are looking at deals, do you typically bring them down, do everything yourselves, or do you work with other co-GPs on these projects? What does it typically look like, Jay?
So typically me and two of my partners, if it's a small to mid-sized deal, 30 to 50 units, we take it down ourselves with our set of investors. For larger deals, $10 million and above, where the raise amount is anywhere around 4 plus, we do get it a few co-GPs. Some of them we've already worked with in the past. So for us, when it comes to co-GPs, we don't believe in posting on Facebook that we are looking for co-GPs.
Yeah.
It's got to be a relationship that we have been in and we truly know the other party. That way, if things do get rocky, if the deal has some challenges, we are able to conquer those challenges together rather than working with somebody you don't know. And now it's all a blame game once things are not going well. So we try to limit.
It sounds like you've gone through a few painful learning experiences that way, Jay.
Yes, I think, aren't we all? I mean, every time you do real estate and partnerships, I think there's always going to be a few challenges. Thankfully, none were horrible where we lost our shirt, but there were definitely lessons learned. And we understood what type of people we like to work with, people with a long-term vision, because all of our deals we underwrite for 6 to 10 year holds.
Yeah.
So, we don't want to partner up with someone who is trying to double their money in 2 years, because that's just not happening in multifamily right now.
Yeah. Yeah. I think people got a little bit spoiled a few years ago, and those go-go days are behind us for a while, that's for sure. So yeah, realistic expectations, very, very important. So when you are looking for co-GPs, what do they typically bring to the table? Are you just really focusing on the capital side of things? Are they involved in operations? Sounds like you guys are pretty vertically integrated yourselves. So what other roles do your co-GPs tend to play?
So they help with the capital raise, but also are active on the deal.
Yeah.
In terms of how active they are on the deal, typically they form the second line of defense. So the first line of defense is our own property management team and asset management team. So we do both of those in-house. DJ, my partner, runs the property management company, and we have an assigned asset manager per property. But we always need a second set of eyes looking at all the financials and making sure that we are doing expense reviews. We are tracking our actuals versus pro forma, budget versus actuals, all of these metrics. So usually when we bring in co-GPs, they do get that role of basically acting as a second line of defense.
Yeah,
so that way,
almost like quality control, right? So
almost like quality control. It's really supporting the asset management function.
Yeah.
Because most of the co-GPs that we have worked with are not local. They are out of state. Yeah. So they cannot do anything that requires boots on the ground support. So typically looking at the financials and KPIs and numbers is where we can use their help.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah. Well, that makes a lot of sense, Jay. No, that's great. Everybody in their lane, providing value, letting you guys focus on what you guys do best. So speaking of the whole capital raising side of things, a lot of syndicators have gone through some rough times over the last couple of years with everything that's gone on in the market and multifamily and interest rates and property taxes, insurance, everything that's going on. Has that affected you guys when it comes to raising capital for your deals? And if so, how?
It definitely has affected, right? I mean, we are seeing investor confidence is pretty low right now, especially for multifamily. And a lot of investors are now pivoting to funds that are buying businesses and car washes and paving companies. An ATM fund that I was personally invested in that turned into a Ponzi scheme. What I'm hearing is a lot of these other vehicles are also not delivering the results that they had promised.
Yeah.
So people have a tendency of chasing shiny objects. but which is the reason why we stuck with multifamily. I mean, as sponsors, we are barely making any money. All the acquisition fees we typically reinvest in our deals. We just put that back into the deal. So we are not getting any money, but we stuck with multifamily because we truly believe in that asset class. In the long run, the rents are going to come back up. We are providing a basic human need, and that's kind of why we stuck with it. So I think our goal right now is to basically educate our investors on why multifamily is still a really good asset class. And it's all about risk-adjusted returns and not only looking at those 20 plus IRR deals, which may either give you 20 IRR or fail completely altogether, resulting in loss of capital. But thankfully, it did not impact us as much because we haven't had any capital calls or loss of equity or capital. We had no exposure to bridge debt across all the deals that we have done. They were done with either local bank or agency loans. So they were fixed for 5 to 7 years. We do have a lot of recourse debt, so that's more risk on us as sponsors. But at least when the rates went up like crazy, it had no impact for us.
Well, I think the other smart thing that you guys did is you focus on a specific kind of deal in a specific market area that's your own backyard. Plus, you're very hands-on. A lot of people that got into trouble were chasing deals very far away in markets that were, a lot more challenging. That's for sure. So yeah, no, that's agreed. I'm glad things are going well. So now we're almost into 2026. What are your plans for that new year, Jay?
So 2026, we do want to close on more multifamily deals.
Yeah.
Like I said, 50 to 150 units is kind of our target buy box. Over 150, the deal becomes pretty big for us right now. We have always believed in scaling slowly and steadily. That way we have our systems scaled to handle that kind of volume. And we have the capital raise capacity as well to take down a deal that big. We never have a door count goal like 1,000 doors in 2026. If we find 1,000 quality doors, we will take them all down. If we only find 100 quality doors where the numbers work, we'll only do 100 doors. So we don't have a door count goal. It's all about the quality of the deals. Last year we closed 4 deals. This year we are closing our second one. And that really goes back to not having that door count goal, because I've seen a lot of people getting into trouble just trying to buy properties to increase their door count goal. Yeah. But continue to focus on multifamily in that size range, primarily in Class A and B neighborhoods of Cincinnati, but also opened up to Columbus, Lexington, and Indianapolis, being adjoining markets. And also we have a scattered site portfolio here in Cincinnati. So if there's a smaller property that fits into that scattered site portfolio, we even take down a 20 unit or a 30 unit as a joint venture deal with just 2 or 3 investors. So we do a kind of a mix of all of those, but our focus is to go after those 50 to 150, because that's where we see our return on time is the best, as opposed to buying a lot of the smaller stuff.
So Jay, I believe last time we talked a number of years ago, you were still working at your previous profession. Now you've moved into real estate full-time. Are all 3 of you full-time in the business, or some of your partners still working outside?
Yeah, so my partner, DJ Young, who runs the operations and property management company, he's been full-time real estate investors for quite some time now. Mm-hmm. And my other partner, Andy Crawford, he still has a W-2 job. He's a executive at a pharmaceutical company, and he leads our investor relations. So he's also able to network with a lot of doctors and folks in the pharma industry through his current role, and help raise capital that way as well.
Very good. What's your primary role in the company these days, Jay?
I primarily work on acquisitions now. I used to work a little bit on the construction side, construction management as well, but my partner DJ has a good handle on it now. Mm-hmm. So now acquisitions is my primary role. And then with Andy, I help him with investor relations to some extent. So to some extent, we all wear all 3 hats.
Of course. Yeah.
But 90% of my time now is acquisitions. 90% of my partner Andy's time is capital raising and investor relations. And DJ is fully focused on property management and construction management.
Very good. Well, Jay, this has been fantastic catching up with you. if people would like to connect with you and find out more about what you guys are doing in and around Cincinnati, where should they go?
Yeah, I think the best place to find us is our website, prospercapitalco.com. And that's where, you can fill out a form. That way you start to get emails from us. And if there are any deals that we are doing, you would be notified of those deals as well. So that would be the best place.
Fantastic. Jade, thanks so much for being on the show.
Awesome. Thank you, Dave. Appreciate it.
All right, everybody, take care. We will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.